Welcome to Second Take, the show that focuses on the issues behind the news. Speakers at the Joburg Indaba last week discussed the South African mining industry's delicate make-or-break phase, the need for stakeholder convergence and mining CEO incentives. Mining Weekly editor Martin Creamer tells us more. Welcome, Martin.
Thanks, Leandi.
Firstly, Martin, can you tell us what is the current state of the South African mining industry as was discussed at the Indaba?
Well, they painted a very pale picture of its old self, particularly Rick Menell, whose family were part of the Anglo-Vaal mining empire. It was a very big group of mining companies and industrial companies, which he ran the mining section of for a while. Points to the time in the 70s when, by any measure, South Africa was 50% of the world mining industry. Well, he said, the stark news is that we're down to 4%, and that's a diminished industry. So, it's really, we've lost that opportunity to actually create wealth from our national patrimony. It's there in the ground. It's got to be taken out, needs to be taken out economically, and we've lost the ability to do that. So we're no longer big on any portfolio manager's portfolio. So, no one's rushing out to invest in our companies like they were in the past. And that creates a bad situation because raising capital is crucial. The domestic markets are just not big enough to give you the capital you require to build mines at scale. And we haven't really built a big mine for ages. We don't build greenfields mines anymore. We don't seem to be doing any exploration, although we're proud to say we've got $2.5 trillion worth of metals and minerals in the ground. They'll stay in the ground at this rate because there isn't the money, there isn't the know-how, there isn't the modernization, to bring these to surface and turn them to account, which is a huge pity. So, Rick Menell also sketched the downside that, we need to do something about this, as did some of the other speakers.
Yes, and then the topic of stakeholder convergence to ensure a positive future for the South African mining industry also came up at the Indaba. What would this entail?
Well, it's a give and get. You have got to gain and also take some pain. And this is what all the speakers were sort of quite at one about, that there's no chance of us doing anything with our mining industry until we can work as a collective. And those are the stakeholders, that include labour. They also include communities, because these days communities, they pop up and they can halt mine production because they get unhappy with their share of the cake. So actually trying to give everyone a little bit of the cake is the way they're thinking. So they're calling it convergence, come together and have a united front. And if we don't do that, they're warning that, you start getting government interference because the government is concerned with jobs. So suddenly you're in a situation where you have to downscale because you're not coming out. And then you need to reduce your workforce because you're not producing as much productively. When that happens these days, you find that a Minister of State starts interfering. Now, if a Minister of State starts interfering, that it can mean that there's a big delay in actually the rescue of your business, and you start bleeding cash. And the more people get involved, the more risk you're at, because we saw, we're looking back in Africa in the days when, for good reason, people used to nationalize mines. But they imagined that you could then take that money that you got from the mines and not put it back in the mines. Put it into, in Zambia's case, building Lusaka, or, subsidizing the bread price, or doing things with it that were non-mining related. And then all of a sudden you think, wow, all this is gone, because you've got mining as an ongoing business where you've got continually preparing the next step. And if you don't pay for that, you can't do anything. You get paralyzed into immobility. So we saw, those mines sort of cave in. And it's only recently, since they've been re-privatized, that Zambia, as the case was raised, is back to about 750,000 tons of copper, which is very, very important. Unfortunately, it's a time when the copper price is down. So that's the sort of situation. People misunderstand, how this business works, and they run into trouble. So he's saying, look, if you start interfering about retrenchments, we don't want to retrench people. It's the last thing we want to do. But we sometimes have to. We have to downsize. If you start interfering there, it starts leading to a position where we're bleeding cash, and then you might say, well, the state can do this better. And then the state gets in. If Africa and other places in South America, any example, if you nationalize, your mining industry is finished. And so, people were saying that it's going to take you like 20 years to come back if you start getting into that problem. So keep away from that. Let's really sort it out, have convergence, modernize, work together. But it needs all those stakeholders to move forward. And at this stage, they're not moving forward collectively. You still have people holding out.
Then, Martin, at the Joburg Indaba, mining bosses were also criticized for inept capital allocation. What was meant by this, and how did this come about?
Yeah, so fund managers, they were quite vigorous in their condemnation of the way in which CEOs, particularly mining CEOs, are incentivized. They say most of the CEOs get to that top position because they're good at mining. So operationally, they're strong. All of a sudden, the board of directors misdirects them and says, look, here are some shares. You're going to be incentivized with shares. So if you do well and these shares rise in value, you're going to be able to cash in. They're saying that's totally misguided, because you're finding that these CEOs who used to think long-term operationally now thinking short-term, and they feel that they must just increase the size of the company because then the share price will increase, then everybody's going to make a lot of money. And when they see things not going too well, they leave. And then, they hand it out, they leave it in a mess for someone else to come in. So they were even saying that those shareholders those CEOs who got shares now, they should be now banned from ever being allowed to sell them for at least 6 years after they leave, because they want to end the short-termism, because they're saying the only people who haven't made any money out of mining are the shareholders, the investors, And now the investors are saying, we're not going into mining. So that is hurting the industry very badly. So they want to change in the thinking and the capital allocation. They say, these CEOs, they're very good miners, very good operationally. Now you tell them they must start allocating capital. So they've got this capital, and in comes a investment banker and says, why don't you take over this company? Why don't you merge with that company? Because the banker wants to make a lot of money. So they're saying, keep away from those guys. You shouldn't be involved in those sort of decisions. And the boards just rubber stamping everything you do, that's got to end. So they're looking for a total new era. It's not only modernization of the equipment that they want to do, not only modernization of the labor laws, but it's also modernization of the way boards act, the way CEOs just cream it, very disturbingly, make a lot of money and then walk away. The industry isn't the better for it. So it is a situation where perhaps good will come out of this downturn, that it's such a tough time at the moment that everybody's seeing the flaws in the industry from top to bottom, and nobody is escaping the wrath of the investor. And in the meantime, investors find solace in going into food and other pursuits that make them a bit more money. But that is hard on South Africa, because we've got this as a national patrimony, and we should be doing something with it, because we see that we haven't covered ourselves in glory as a country. A lot of people on the streets at the moment, a lot of activity that we could do without.
Then, Martin, were there any proposed solutions to ensure better shareholder returns?
Yes, well, they were saying, look, why give these incentives that are share-based? Why don't say, hey, this fella, he's a CEO, he's very good, and actually he's good in production. Why not give him a bonus based on the way he drops unit costs? He brings those unit costs down, and he extends the life of the mine. You're now getting a more valuable asset that will last longer. And think of other operational metrics, that can be worth giving someone an incentive for, because it's going to be a realm that doesn't sort of go up and down with the market. It's there, whether the share price is up or down, it's there, and it should also help the share price.
Thank you so much, Martin.
It's a great pleasure, Leandi.
That's it for today. Join us again next week for more news analysis on South Africa's mining industry.